Most people are asking the wrong questions about mortgage rates in 2026. It's not when will they drop, it's why they would, what could delay them, and how to position yourself before the market reacts. That's exactly what we're going to cover today. This is my official 2026 mortgage rate forecast, and it's built on the same forces that actually move rates. Not headlines, not opinions, and not guesses. If you follow me on a daily basis, you realize mortgage rates are driven by a few key pillars. That's inflation, jobs, wages, energy prices, government borrowing, and even the bond market. So instead of predicting a number, we're going to walk you through the whys, because when you understand the why, you're going to make better decisions. So folks, my name is Dan Frio. I'm the host of the Rate Update, and I come in each day to explain to my clients what the heck's going to go on with those and the whys behind it. Last year was pretty an interesting year. I was contacted by News Nation 2 times, Yahoo Finance, NBC, and other big networks asking me, Dan, what's going on with rates? How come when the Federal Reserve cuts rates, they don't go down? Well, that's probably your question as well. Well, today we're going to talk 2026. We're going to go over all the key elements that really play a role in these things and the whys behind it. So at the end of this video, I'll tell you what I think is going to happen with rates. You guys can give me your predictions down below. But before you do anything, check out my videos from last year and even the year before. Let me know what you think I did on those. Give me an A, B, or a C. I think we nailed rates and we also nailed the housing market. But you're here for mortgage rates. So without further ado, folks, let's get over to it. Okay, so the first starting point that I want to take you to is right through here. How do we understand where mortgage rates are going to go? So I'll give you my overall base camp view here. I think in 2026, mortgage rates are basically going to be stable. They might drop just a little bit. I know that's not what you want to hear. I know that's what the markets don't want to hear, but I'm going to provide you all the data points on why I think that mortgage rates might just stay sticky where they are. They might drop just a little bit, and the whys, I would love your comments down below. So without further ado, here's what we're going to go over. We're going to go over some information on what the Federal Reserve looks at when it comes to setting rates, and then also what the markets look at to determine where rates are going to go, because mortgage rates are actually created by a bond. But first off, let's get over to the Federal Reserve. What are they expected to do in 2026? So the Federal Reserve, what they do is they monitor things like this. They control the federal funds rate, which is right through here, and we're going to talk about that in a second. But to control this, they monitor things like inflation, and they monitor it with the PCE. They also watch the unemployment rate, and we're going to talk about these things. And the last but not least, they also look at the GDP. So what they've been saying is over time, they're like, okay, we know inflation based on the PCE is getting a little bit higher than that 2.0 rate that we really want, and it's staying sticky. It's not getting back down to that 2% range. So why should we cut rates? But then on the flip side of the coin, they're saying, okay, the unemployment rate's starting to tick up. So that's bad news. So what should they do? Well, the Federal Reserve was created for 2 mandates. One, it was to keep inflation, aka prices, in check. And the other piece of the puzzle is the unemployment rate. Anything under 5% is called full employment. So based on this, the economy's at full employment. So why should the Federal Reserve cut rates going into this scenario? Well, let's break it down. First off, the Federal Reserve came in at the last meeting and told us, well, based on the dot plot, that they really don't know what they're going to do. Okay, so here's what the dot plot is. Every 4 times a year, the Federal Reserve meets, and they put a dot where they expect the federal funds rate to be. Remember, we said the federal funds rate currently today is 3.5 to 3.75. So if we go back to this chart, you're going to see right through here, the federal funds rate in 2025 was 3.5 to 3.75, and that's where we ended the year. Now, here's the confusing part. If we scroll over to 2026, the consensus vote is, well, there really is no consensus vote. Well, so this doesn't really give us much direction. Well, some direction we're going to have is the Federal Reserve chairman, well, he's going to be resigning or retiring in May. So we're going to have a whole new Fed chair. But in February, we also have another person that's taking an early retirement. So we're going to have 2 new Fed officials by June. So by Q2 or Q3 of this year, my expectations on some of these things might change a little bit. So that's what the Federal Reserve has told us, and the probabilities of a rate currently are right through here. So in 2026, they're saying, well, in the January meeting, we're not going to cut. In the February or March meeting, we're not going to cut. We might cut April. Well, that's one rate cut and maybe one other at the latter part of the year. But we know even if the Federal Reserve cuts rates, that doesn't mean mortgage rates are going to come down. So now the other piece of the puzzle that the Federal Reserve monitors is inflation. So if we look at inflation, what has it done? Well, in 2024, it got pretty darn close to that 2% trigger that the Federal Reserve really wants, but it didn't get there. Then in 2025, we had some inflation tick up just a little bit, but right through here, inflation didn't reignite. It mostly increased a little bit from tariffs and then just flatlined. So that's what the takeaway is through here. So here's my expectations on some of these things. If you go down through here, my risks are this. I think we're going to see some inflationary pressures in the first few readings of the year. And here's why. I think a lot of companies wanted to increase their prices, but they couldn't. So what they did is they waited till after the holiday season and they came into January and they said, okay, now we can offer these special programs. This is new and improved. Now they have the ability to increase their rates. So I think that's what's going to happen. So the first few prints in January might be pretty bad when it comes to inflation. From there on, here's what I think is going to happen. You're going to have down through here, we're going to have a cooler job market. It's not falling off a cliff. But then over through here, the consumers they're going to rally back against this. They're saying, no, you can't increase these prices. So I think prices are going to stagnate. And then when housing inflation and other pieces of the puzzle start to come in play, we're going to start seeing inflation dropping from there. Well, then the other piece is right through here. If inflation cools in Q2, which I'm expecting, that'll give more room for the Federal Reserve to cut rates. So then the other piece of the puzzle are tariffs. Are they going to be detrimental to us? Well, like I was just saying, here's my thought. I think tariffs already worked their way into the system, but there's also going to be one more bump in January that we're going to see based on a lot of these things. But there's another piece of the puzzle that we want to talk about here in a second that you might miss on a daily basis that I actually do talk about. So right through here, expectations are basically a bumpy beginning of 2026. But in Q2, from there on, I think mortgage rates and rates in general just start to improve and maybe ease down just a little bit more. So then let's get over to the labor market. This is that piece of the puzzle that the Federal Reserve is saying, okay, this is our main culprit right now that we really have to monitor. Well, the takeaway on this is right through here. The jobs market has been cooling, but it hasn't been collapsing. Fewer bidding wars for workers typically means slower wage inflation. The takeaway right here is slower job growth and moderate wages tend to reduce inflationary pressures, giving the Fed more room to cut rates. So that's what we're seeing on that side of the equation. So that's another reason why maybe the Federal Reserve will cut rates a little bit more. Then you go over to the deficit. Now, this is a piece of the puzzle that people they don't look at, but you guys know I'm a stickler when it comes to the deficit. And this is really what's propelling or keeping rates at the levels that we have right through here. So right now, we're going to have two scenarios that we're going to face in 2026, and they're right through here. Are tariffs going to be soft and get diluted through the system, and inflationary pressures cool into mid-year? Long-term yields will stabilize, and mortgage rates might just start to gradually decrease. But let's say tariffs are as bad as people expected, the markets, the economists. So we have scenario B. What could happen there? Will tariffs pass through and they stay sticky and inflation expectations remain firm? Investors demand higher yields. What's going to happen? Well, mortgage rates would go up. So what should you look at? Well, what to watch? Inflationary trends, the job market, see if it's cooling or not, Treasury issuances. These are all the things that we go over on a daily basis. But last but not least is right through here. Here's the thing that I talk about on a daily basis that I think goes over a lot of people's heads. Oil. Oil is a huge piece of the inflationary numbers. Okay, so you're going to have two pieces going on right now. Oil, is it going to stay below $60 a barrel? Or is it going to go above $60 a barrel that we've seen over, during COVID, where it was like $85, $90 a barrel? Well, let's go over through here. Scenario A, oil stays low due to stable supply and moderate demand. Inflation remains contained. The Fed becomes more comfortable and can ease. That means lower rates. Well, how about if oil stays low because demand weakens sharply? Inflation cools faster, but the growth risks are there for the Fed, so the Fed could cut more aggressively. Don't think that's going to happen. So here's what the takeaway is. If oil stays below $60 a barrel, it becomes one of the strongest forces holding inflation down in 2026. When you add that, the housing inflation that I think you're going to see a shocking surprise on those news events that come out here soon, on the housing inflation numbers as they drop, you're going to see inflation overall dropping in Q2, Q3, and further in Q4, possibly in the range where the Federal Reserve wants it. So now, based on all this information, what do you think is going to go on with mortgage rates? Let me know down below, but here's my thoughts. I'm staying with my thoughts of right through here. So my expectations in 2026 are this. They're going to stay basically right where they are right now, 6.2, 6.25. They could trend down just a little bit. So that's my base case. Well, let's say the markets go nuts and everything just goes bad, inflation spikes and all this other. Well, the Fed's not going to cut rates, so you can have this over here. But let's say everything comes in good. Inflation's good, but the jobs market's bad and everything. You could go here. Neither of these scenarios even come close to being possible. My expectations are right over there. If that's not the case, the B scenario would be right through here. So the final conclusion, folks, is let's take all this day and make sure on a daily basis you watch these things. So what you need to focus in on is where rates are today, where they're going to go tomorrow. And if you're a homeowner, what should you do? If you're a home buyer, what should you focus in on? So let's get over to what I do for a living. So if you're a homeowner and you're trying to track rates, I got the tool for you right up through there. I created RateWatch 2.0 for homeowners to track mortgage rates. So what's going to happen is when a rate hits exactly where you want to be contacted to refinance, I'll reach out to you. So plug in your mortgage information. Let me know what interest rate you'd be interested in refinancing. When the rate hits there, I'll give you a call, text, email. We'll go over what the new payment would be, what your costs would be, and what that break-even point would be. If it makes sense, we'll get you locked in and get your savings started today. So folks, hopefully now you understand a little bit more about who I am, what I do, and also that saying that I have each day. What the heck's going on with those and the whys? If you haven't subscribed yet, please, you can do so over there. Also click the alert bell because every time I post a video, you can be alerted. We also have live events, and join us each Wednesday where I go over my slogan, one application, one credit pool. How do we compare your loan with over 30 different lenders? Join us each Wednesday to learn how. Thanks for watching, folks. I hope you learned something, and I hope you have a happy and prosperous 2026. Take care. God bless. Bye-bye.